Welcome back to Trader UK, the money management channel. I'm back with another tax explainer, but today we're going to be looking at capital gains tax, one that all the investors out there will certainly be aware of. Before we do get going today, as always, if you could like the video for me and don't forget to subscribe for more similar content. In today's video, I'm actually going to do two things. Firstly, I'm going to show you how to calculate a capital gain, because there can actually be quite a bit to this. And then I'll show you how you take that gain and report it to HMRC in order to pay your tax liability. Capital gains tax is, of course, a massive subject to cover, many different asset types out there. For the purposes of today's video, we're going to concentrate on the gain that you might make when you're buying and selling shares. We're also going to forget about capital gains allowances, and we're going to assume that this gain needs to be declared to HMRC, even though that isn't always the case. You can check out my previous video, Started Investing, Now What About Tax? I'll link that one down in the description. That will go into more detail about exemptions and allowances when you're investing. So the first part to this will actually be realizing when you've made a chargeable gain. I've had a number of comments on the channel before that were a little bit vague. People seem to think that providing they reinvest the money or they keep it sat in their trading account, then they haven't actually made a gain and they don't need to declare anything to HMRC. That isn't actually the case. That's not quite how it works. So I'm going to go into a little bit more detail on this. Now, let's take a look at the guidance from HMRC on working out your gain, which is actually the most difficult part of this. Reporting your gain to HMRC is really easy. Calculating your gain is quite often more complicated than you would expect. Remember, I always say, if you want to be sure that the information you're getting is correct, use this site, gov.uk. It's straight from the horse's mouth. And you'll be able to find this page, tax when you sell shares, working out your gain. You'll need to work out your gain to find out whether you need to pay capital gains tax. Your gain is usually the difference between what you paid for your shares and what you sold them for. That makes it sound very, very easy, but we'll come on to the problems we might encounter in a second. So we have a paragraph on market value as well. I'm not going to run through this part. It won't apply to most people, but usually if you're giving away your shares or selling them at a reduced rate, or they're given to you, HMRC won't just say, well, there was no gain because there was no money exchanged hands. They'll assume a market value and say, well, there was actually a gain made by someone, and they'll make sure they get the tax at some point, but it won't apply to the majority of us. Then we've got selling in special circumstances, and this is actually what's going to apply to the majority of us. It might not seem like your circumstances are very special, but this is what we fall under, or the majority of us anyway. There are special rules for working out the cost of your shares if you sell shares you bought at different times and prices in one company, shares through an investment club, shares after a company merger or takeover, employee share scheme shares. So it's the top line there. Ignore the other three. They're probably not going to be relevant to 99.9% of people out there. But the top line is going to be relevant to almost everyone that's investing. Shares you bought at different times and prices in one company. So if you think about, for the majority of people out there who are investing, and you might find this yourself, it's quite rare that you just buy 10 shares in a company, hold them for a couple of years, and then sell them off. If you do that, great, it's really easy to calculate your gain, but most of the time, you have a company that you like, you average in, you buy a few shares today, the price drops down next week, you think it's a good opportunity to buy some more, you buy some more, all at different times, all at different prices. So it then becomes a little bit difficult to calculate what you've actually paid for those shares. And often as well, you might hold 10 shares in Tesla and you might want to sell 5 of them. So it's kind of mix and matching that you have to deal with here. And if you have bought shares at all different times and all different prices, and then you sell part of your holding, it's quite difficult to know what cost you should use. Should you use the first shares that you ever bought, the cost that you paid for those, or should it be the last shares that you ever bought? So HMRC have actually come up with specific rules to deal with this. So I'm going to move on to the One Company tab, and we'll look at what those rules mean for us. So when you sell your shares, it's quite easy to know what you sold them for, the price that you achieved for them. But like I say, it's difficult to go back and know what they actually cost you if you bought them across a number of transactions. And that's what this will help us do. So it says here, selling shares in the same company. There's a different way of working out your cost if you sold the same type of shares in a company that you bought at different times. If you've been averaging in, for example, you'll usually need to work out the average cost of your shares and deduct this from what you got for them to work out your gain. So that seems quite straightforward. The example as well, very, very easy. You bought 100 shares at 80 pence each. The total cost is £80. You later buy 300 shares at £1.20 each. The total cost is £360. In total, you have 400 shares costing £440. The average cost of each share is obviously £1.10. So if you sell 150 shares, the cost of the shares for your tax calculations is £165, which is £1.10 multiplied by 150. Deduct that from what you sold the shares for to work out your gain. And again, that might make it sound very simple. It's just a weighted average. That's kind of what you would expect anyway. But there is another step to this that complicates things a little bit. Just below that, it then says, if you bought new shares of the same type in the same company within 30 days of selling your old ones, there are special rules for working out the cost to use in your tax calculations. Now, I recently did a video about an article that came to light about a potential doubling of capital gains tax up to 40%. In that video, we said about ways to get around the capital gains tax and that you can sell off your shares at the end of a tax year and then buy them back into the new tax year. Now, these rules that they have here, these rules are to try to combat this. And I say try to combat this because they don't tend to work too well. But we're going to take a look at them in detail. How HMRC try to stop you from selling off a portion of your shares and then buying them straight back again. And it's called bed and breakfasting. But we'll take a look at that in some detail now. So this page here, this is like your detailed guidance from HMRC. So it starts to get a little bit more complex, the language that they use here. So we'll skip over some of it. We'll just go to the key parts. Number one, why are special rules needed? Shares of the same class in the same company are identical. Suppose you've been holding 12,000 Wilson and Strickland PLC 25 pence ordinary shares acquired at different times for different prices. You then sell 2,000 shares. To calculate the gain, you need to know how much cost can be attributed to the shares you've sold. The capital gains rules for shares allow you to do this. From the 6th of April 2008, all shares of the same class in the same company are together called Section 104 holding. You add together the cost of the shares in this holding. Each share in the holding is treated as if it's acquired at the same average cost. So that's what we looked at before, taking a weighted average of the shares that you've purchased and then using that average price to calculate your cost. There are a couple of circumstances in which shares will not be regarded as becoming part of that 104 holding. Mainly shares affected by bed and breakfasting and same day rules. We're going to skip over the first example because it's not very helpful, and then point two, this is where we'll start. How to identify the shares disposed of. When you dispose of shares, you cannot work out your capital gain or loss until you have matched the shares disposed of with shares you acquired. You're treated as disposing of shares in the following order. So these are your share matching rules. So when you make a gain, you need to come to these rules and check if any of them apply to you first. So when you're calculating the cost of the shares that you've just sold, you're going to do it in a certain order and you'll need to refer to these rules to check if any of them apply. First of all, you're going to go against the shares acquired on the same day as the disposal, the same day rule. So if I sell shares in Tesla today and tomorrow I buy them back, I would normally do that in a case where I want to crystallize a gain and make HMRC utilize my allowance at the end of a tax year. You actually have to use the cost price from that same day acquisition, which means that you bought it on the same day. You're not going to have made much of a gain or a loss, but that's exactly what HMRC want. Then the second step, you're going to allocate against shares acquired in the 30 days following the day of disposal. And this is your bed and breakfasting rule. Provided the person making the disposal was resident in the UK at the time of acquisition. There's slightly different rules if you're non-resident. But yeah, it's going to apply to the majority of us. So again, if I sell my Tesla shares today, but I buy them back in 10, 15 days time, I'm actually going to have to use the cost price from when I bought them back 10, 15 days time, which again means they've probably gone up a little bit in value or come down a little bit in value, but you're not going to be crystallizing the gain that you thought you might be crystallizing. So watch out for that. And then the third step is to allocate against shares in the section 104. So that's where we go back and we'll just take a weighted average of our combined holding. But you have to go through steps 1 and 2 before you get to the average holding. Let's quickly look at the example that they have below. Very simple. So Mr. Schneider owned 10,000 shares in Mesopotamia PLC. 500 were purchased on the 11th of September 2019. The remaining 9,500 are held in the section 104. Mr. Schneider sells 4,000 of his shares on the 30th of August 2019. The disposals are identified as 500 against the shares purchased on 11th of September 2019. Because he purchased those within 30 days, you're going to take the cost price from those 500. And then the remaining 3,500 can be a weighted average from your kind of pool that you have your section 104 holding. So you can see that these bed and breakfasting rules are designed to stop you selling right at the end of the tax year, buying them back a few days later and staying in the market the whole time. But they don't tend to work too well, like lots of rules that HMRC introduce. Maybe that's by design. Maybe HMRC want you to have ways around this, but let's just take another look at the rules and see why they don't work too well. So first of all, the easiest thing to do is wait for 30 days. On the 31st day, you can just go and buy your shares back and you'll be outside of these bed and breakfasting rules. By letter of the law, that's absolutely fine to do. You can buy back, if I sell Tesla today in 31 days, I can buy back my Tesla shares and I'm outside the scope of these rules. Secondly, those with an eagle eye will notice that although they look forward 30 days, they don't look back 30 days. So if you have enough cash disposable, what you can actually do the day before you're going to sell your Tesla shares, you can just buy them the day before, the same amount. Now, it doesn't work as well this because those shares that you buy, they're going to go into your section 104 pool at the high cost price. So you're actually only going to end up realizing 50%, about half of the gain that you thought you were going to realize, but it still allows you to do that. And of course, these rules only apply to the same asset class. So assuming that I sell my Tesla shares and buy back Tesla shares, yes, you're caught by these rules and you need to adhere to them. But if I sell my Tesla shares today and I buy Amazon shares tomorrow, that is a different asset class. I can remain in the market, but I've already crystallized my gain on the Tesla shares, which is normally what you're trying to do. And there's also a number of more creative ways to get around it as well. Bed and spousing, some people call this. So if you have a spouse or a civil partner, transfers between the two of you are considered exempt from capital gains tax. So if you're going to sell Tesla shares today, you can get your spouse or your civil partner to buy them back tomorrow in their name. Providing it's in their name, that's not a problem. Again, you remain in the market, you crystallize the gain in your name, and then at some point, 31 days later, you can transfer those shares back into your name. And then it gets more and more complicated from there. People will use CFD accounts to stay in the market for the 30-day period, but there's a number of different ways around this. So yes, keep an eye out for bed and breakfasting rules, but providing you're looking at this and you're taking into account the dates, there's plenty of ways to get around it. And now that we know our cost price, we can actually go back and finish calculating our gain. So I'm just going to go back to the guidance. And you can see here it says what to do next, deduct costs. You can deduct certain costs of buying or selling your shares from your gain. These would include fees from your stockbroker, stamp duty reserve tax when you bought the shares. So stamp duty reserve tax, 0.05%, that's only going to apply to UK-based companies. And then the fees, some of us will incur fees, some platforms charge, some don't. But if you do, you can deduct that as well. It says below you can then apply tax reliefs. You may be able to reduce or delay paying capital gains tax if you're eligible for tax relief. Let me tell you, you're probably not eligible. I can take you to have a look at the table. So you have a number of reliefs here, but I'm betting that not one of them will apply to you. Entrepreneurs relief. You have to own 5% of the shares in a voting company and work for that company, and you can potentially get a reduced rate if you're a higher rate taxpayer, so not much good for us. Gift holdover relief, pay no capital gains tax if you're giving your shares away. So you don't need to worry about that if it's to your spouse or your civil partner, but if it's to someone else, maybe a family member or a friend, I don't know why you're giving away your shares. You're not going to make much of a profit if you're doing that, but you can roll your gain across to that person, so you're not caught by the capital gains tax. Enterprise investment scheme. So if you're investing in unlisted companies, then you can claim enterprise investment scheme. Unlisted companies are not very liquid, and I can't imagine we have many opportunities to invest in unlimited companies. It's not like buying on the stock exchange, so not really going to apply to the majority of us. Seed enterprise investment scheme, it's pretty much the same thing, except you're looking at even smaller companies, more high risk, less liquid, so not going to apply to us. And then rollover relief at the bottom. I think this is where people get confused. People think that if you roll over your gain into a new investment, then you don't have to pay the tax, you don't have to declare it, but it doesn't apply. You can see delay paying capital gains tax if you sell unlisted shares. Ours are listed on stock exchanges, New York Stock Exchange, London Stock Exchange, etc. But it's when you sell these shares to the trustees of a share incentive plan and you use the proceeds to buy new assets. So it's no good for us. It's not going to apply either here. So after you've been through the bed and breakfasting rules and the section 104, you've worked out which matching rules you're going to use and which shares you're disposing of, then you can obviously calculate your gain. You can deduct any related costs from that if you do have any brokerage fees or stamp duty reserve tax. And then from there, you just need to know how to declare that gain to HMRC. And there's two ways to do that. I'm going to show you the first one. So the first option you can see here, report and pay the tax straight away. You can use the real-time capital gains tax service immediately if you already know what you owe. You'll click on the link, you'll need a government gateway login. In fact, you will for both of these options. And then you log in, you need to show them a copy of your calculation. So I would always recommend when you're buying and selling shares, it's good that you have your summary in your trading account, but maybe open an Excel spreadsheet and keep some kind of document where you can log the ins and the outs and you can see where you've matched the shares against. It's a painful process, but when it comes to capital gains tax, you have to attach a summary which shows how you've got to your capital gain. So that is the first option. The second option you can see here, report your gains in a self-assessment tax return in the next tax year. So this gives you a little bit more time to play with. The process is pretty much the same, whether you log into the real time or whether you use a tax return to do it. What you're actually entering, all the tick boxes, they're pretty much identical. So it doesn't make too much of a difference. But I am just going to take you through to the tax return to show you what boxes to tick and where to enter your gain. So once you're logged into your government gateway account and you've selected that you want to submit a tax return, you'll need to tailor the return and tell them what sources of income. You'll see the box, if I scroll to the bottom here, it's going to ask you about all your different sources of income. The box at the very bottom is the box you need to tick for a capital gain. If you disposed of any chargeable assets or had any chargeable gains, or you wish to claim an allowable loss, or make any other claim or election, do you need to complete the capital gains section? You'd need to click yes to this question. And then this is the capital gains section that it's going to generate for you. So you have to commit that you're providing honest and accurate information within this section. The questions it's going to ask you: did you dispose of chargeable assets worth more than 48,000? In this example, we'll say no, but obviously if you have disposed of more shares than that, you'll say yes. Have you deducted losses? So if you have made any losses on certain sales of assets, again, shares, then you can include those in your calculation if you want, but you'll need to notify HMRC here. In this case, I'm going to say no. Are your taxable gains more than £12,000? Now, 12,300 is actually your allowance in the current tax year, but last year, 1920 tax year, was £12,000. That's why it's asking me. So if you made a gain of less than £12,000, then let me show you. You'll say no. If you're not going to claim any losses, it's going to tell you that you don't actually need to complete this section, not required to complete capital gains section. But if I go back and say that my gain was more than £12,000, then it's going to ask me more questions and ask to provide more details. It will then ask you, do you want to use the capital gains computation worksheet for any of your disposals? If I select yes, it's going to give you a little calculation to use. So this page is in your capital gains worksheet. You'll actually need to complete one of these for each type of share that you dispose of. So if you dispose of some Tesla, some Amazon, some Google, then you'll need to do one of these pages for every single disposal. Now, if you are making a lot of disposals, maybe you're a day trader or you're trading on a short-term basis, probably you're better to say no on the previous page and you can just give them a total. But obviously you'll need to attach a copy of the workings. I've just filled this out as a bit of an example. So the reference, I've put Tesla. The type of asset are listed shares. They're listed on the New York Stock Exchange in this case. And then a bit of a description. So 10 Tesla shares, however many you've sold, the name of the company, the type of shares if you can. I'm not sure if that's correct for Tesla, but you would know from your trading account. The date of disposal proceeds. Incidental costs would just be if you were charged for making that disposal by your brokerage. Date of acquisition, again, the date that you purchased the shares. It's a little bit difficult really, the date of acquisition, because if you're using the average, remember we looked at the section 104, I think it was, then there isn't really a date. But yeah, I would put the earliest date that you can. Incidental costs on the acquisition. So this could include stamp duty if it was on UK shares, and it could include brokerage fees. Improvement costs. This doesn't really apply to shares, but on other assets you might have it. And then it gives you a bit of a summary at the bottom here. A deduction, if any, in respect of reliefs. We looked at the reliefs earlier, entrepreneurs relief, that kind of thing. Again, none of them really apply to us when we're just buying and holding shares. And a description of any reliefs and elections that you've claimed. So we have here a gain of 17,980 from my example. I'm just going to skip to the calculation page and show you where they calculate and how they calculate the tax on that. Before I move on to the actual tax computation, there is actually one or two more pages. You can see on screen, it will ask you about losses and adjustments. So it's really important that if you are trading and you're making losses, you should be declaring those losses to HMRC. You can see here the top box, you can enter losses that you've declared in previous years to reduce this year's gain. So if I enter £1,000 of losses in here, providing I've reported those to HMRC, then I can utilise them against this year's gain. You also have income losses of this year to set against the gain. So if you do have any losses, again, you could enter it here. Let's put another 1,000 in. And then losses available to be carried forward. So if you utilise all your losses in this current year and you've still got more to carry forward, this is where you would enter it, okay, so that you can then utilise them against future gains. And you've got gains qualifying for investors relief, entrepreneurs relief, capital gains, adjustments, etc. Again, most of it's not going to be relevant because we don't really qualify for those reliefs, but just so you know, there is this extra page in between. And then, like I said, you need to provide a computation to HMRC really of how you've come to that figure. So they'll want to see that you're applying those bed and breakfasting rules, that you're taking a weighted average from your share pool as well. So it's normally easiest to keep that in Excel, but if you've got it on a piece of paper, a photo, you attach it to your tax return here. Now, if you did just have one disposal and it was really simple, then you can just write it in this box. I bought 10 shares on this date, I sold them on this date, and they would accept that. There's no need to really prepare a computation, but technically they want to see one. And then you can see the tax calculation here. So it looks like it's taken off the 12,000 allowance that you have, capital gains allowance, leaving you with 3,980 taxable. Because you're a basic rate taxpayer in this case, I haven't declared any other sources of income, then it's at 10%. If you're a higher rate taxpayer, then it's going to tax you at 20%. And that would be it. You submit that to HMRC, you'll make the payment to cover your tax liability of £398, usually before the 31st of January, which it does mention below there, and then you're done. You've informed HMRC of your capital gains, and there isn't really any need to do anything else until the following tax year. So that is it, guys. I hope you found that useful. If you have any questions, let me know down in the comments. Thank you as always for watching, and I'll see you next time.